right, let's talk money now.
Really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there.
All right, that right there was Federal Reserve Chair Jerome Powell talking about the recent rise in inflation over the last few months. With more and more people getting out of the house, settling back into normalcy, prices have gone up for both buyers and sellers. And now, to curb that inflation, the Fed plans to raise interest rates in 2023. So joining us live on set in New York City this morning, business and market analyst, friend of the show, Seth Denson. Good morning to you.
Rachel, great to be here.
You made it all the way from the great state of Texas.
Did. They opened the doors for me eventually.
Oh, look at that. No, we're so happy to have you in person. We always chat about all things money. You're our go-to guy. So explain to us here, but of course everyone at home, in layman's terms, obviously it seems like raising interest rates or raising inflation would be a bad idea, would be bad for us. So how is that actually going to affect us?
Well, I think you got to break it down in two different ways, right? You got to look at inflation and interest rates separately. Because when you think about inflation, that's what we're seeing because of monetary policy, massive liquidity, but no supply because we've shut off the economy. People are at home. There's what we call the whiplash effect. What the Fed will do periodically is to raise interest rates to offset that, effectively trying to curb spending so that the supply can catch back up. So raising it a little bit isn't necessarily a bad thing so long as you get that pendulum not to swing too wide both ways, because when you do, that's when you start to see interest rates hovering around 19% like we saw in 1981 and 82. So the idea for the Fed is, hey, we're in this balancing period where we need to get the economy reopened. There's a lot of money, but maybe we need to raise the interest rates just a little bit. They're saying in 2023, somebody asked me yesterday, when in 2023? I said sometime between January and December.
Like a political answer. Such a politician. All right, we had Dan Geltrude from Montclair State University on the show the other day. Let's take a quick listen to see what he had to say.
Sure.
Initially, they were talking about interest rates hitting 2.4%. Now she's talking about 3.4%. That's a full percentage point. That's quite a miss when it comes to inflation. Will that change Joe Biden's position on spending? Absolutely not. Why? Because that is based on idealism, not based in common sense.
And I know you and Dan host a podcast together, so you guys know each other well. What are your thoughts on the fact of President Biden's $1 trillion spending? Is that going to cause even more problems?
Well, yeah, you've got to get your monetary policy in line, and America's accountant got it absolutely right. That's a 30% miss, by the way, that they did on that. That's not just a little whoopsie. So, you know, when you start to think about that, the Biden administration continuing to want to spend and spend and spend and pump more money, that devalues the dollar. You have devaluing of the dollar coupled with inflation, coupled with rising interest rates. That's going to put us in a really bad position. And if the economy doesn't catch up, we're going to get to a place we call stagflation. And that's what we saw in the 70s, right, where the economy wasn't roaring, employment numbers didn't get down enough, where there was unemployment at an all-time high, and inflation. That's just a perfect storm, and I don't want to say perfect. That's a terrible storm.
And we talk a lot about the people who perhaps don't want to go back to work because they're getting more money at home. We've talked about that for months. But what about people who are trying to find jobs after the pandemic? How is this going to affect them?
Well, listen, a lot of times when money is harder to get, that's what you see when you have rising interest rates. It's less access to capital for corporations. They will slow growth. They'll slow an investment, and that's the idea, is we're going to bring kind of the market back into a level where inflation will connect with where we are. What I would tell the average American is the inflation train has left the station. Get on the train. In other words, get a job now, because as there are plenty right now, that will start to teeter off as interest rates start to rise and inflation needs to be corrected.
Now, long-term projections are showing that inflation is going to settle around 2% in the future. Do you see that happening?
Long-term, let's define that.
How long is long-term?
So inflation historically, if you look over the last 100 years, has settled in around 2 to 3%. So, I mean, that does make sense. But last month we saw 4%. This month we're going to see 5%. I know that the Fed loves this transitory word. I guess all things are transitory depending on how long the transition. And so who knows? But I don't see it hitting 2% for some time, at least 2023, 24.
Transitory seems to be the current safe word.
Yeah. Right.
It kind of encompasses everything. Now, in August, we do know that Federal Reserve Chair Jerome Powell is hosting a virtual town hall. Do you have any idea on what we can expect from that? Little bit out from now.
You gotta love Jerome Powell, right? So last year it was we're not even thinking about. This time it was we're not even going to talk about talking about. So I think that the Fed is in a rough position because he's trying to balance what's going on with an unemployment market sitting where it is, not because there's not jobs, but because we're not filling them, because we're paying people to stay home. So when he comes, it'll depend on what the pendulum is at that moment, but maybe we'll start to talking about it at that point.
Which would be a fun idea.
That'd be great.
All right, Seth Townsend, thank you so much for joining us in studio.
Good to be here.
Always nice to have you on the show.